While you're going about your day, scrolling through your feed or doing something around the house, global markets on the surface look pretty normal. Indexes move up and down, familiar charts appear in the news, big companies report profits, and commentators keep arguing, are we heading for another rally, or is everything already overheated? But in parallel, in the quiet, dry reports of major English banks, regulators and international organizations, the same idea has been repeated for several years now: the system has become too fragile. In this video, we'll calmly unpack why many serious players are no longer just talking about risks, but about a high probability of a sharp market downturn. And what role is played here by English reports and Japanese credit, those very cheap money flows that have been fueling global growth for years. This will not be a video in the style of everything crashes tomorrow, sell everything now. Rather, it's a slow, thoughtful breakdown: how the system is structured, where it is gradually heading, and why more and more people outside of YouTube are quietly whispering about a major crash. Imagine London, one of the main financial centers of the world. Money flows from all over the globe converge there. Major banks, funds, and insurers are based there. And it is there that regulators have been recording the same pattern for several years. The amount of risk has become excessive. If we strip away the complicated phrasing, the picture looks roughly like this. Over the past years, prices for many assets have grown much faster than real profits and the actual state of the economy. This is especially visible in the technology and artificial intelligence sectors. Many AI-related companies are priced as if they are about to completely reshape the world and start printing huge profits tomorrow. Some of them might indeed succeed, but when expectations become unrealistically high, any news that is even slightly worse than perfect can trigger a painful correction. On top of that, there is a massive layer of debt. Households, businesses, governments, everyone got used to the era of near-zero interest rates and borrowed aggressively. Now rates are higher, debt service is more expensive, but old debts haven't gone anywhere. All of this is wrapped in a complex network of financial entities that behave like banks, but technically are not banks. Funds, private credit vehicles, various shadow players. They lend money, take risk, use leverage, but they have fewer reserves and less regulatory oversight. In the reports of English regulators, this structure is described carefully, without panic. But the core meaning is simple: if something big breaks, the shock will hit not only traditional banks, but this entire expanded network, where a huge amount of risk is now concentrated. Now let's mentally move to Tokyo. For a long time, Japan has lived in a reality that seemed almost surreal to the rest of the world. Ultra low and at times even negative interest rates. Money was almost free, yields on government bonds were microscopic. For the domestic economy, this was an attempt to stimulate growth. For the rest of the world, it became a source of cheap funding. From this environment, a well-known scheme was born, which you may have heard of: the carry trade. It works something like this. An investor borrows money in Japan at a very low interest rate, converts yen into dollars, euros, or another currency, and buys higher-yielding assets elsewhere. Anything from US bonds to stocks and loans in other countries. The difference between the cheap Japanese funding and the higher yields abroad becomes profit. As long as interest rates in Japan stay near zero and the yen stays weak, this looks like an almost free lunch. Money from the Japanese financial system quietly flows around the globe and helps push asset prices higher. But every such construction has a dark side. If the Bank of Japan raises rates, if yields on Japanese government bonds begin to climb, if the yen suddenly strengthens sharply, this beautiful scheme turns into a problem. Those who borrowed in yen are forced to unwind their positions, sell foreign assets, buy yen back, and repay their loans. And large-scale selling at the wrong moment can significantly amplify a market downturn worldwide. You rarely hear about Japanese credit in mainstream news, but in analytical reports it gets growing attention. Because this is not just a local Japanese story, but one of the key levers quietly connected to global markets. Let's now carefully, without drama, imagine how English risk factors and Japanese credit might intersect at a single point. Suppose there is a strong shock somewhere in the system. It could be anything: an unexpected inflation spike, a major geopolitical conflict, trouble at a large bank or fund. Against the background of already inflated asset prices, markets start to slide. As usual, the most expensive and fashionable assets fall hardest. Technology, artificial intelligence, everything that used to grow the fastest suddenly starts dropping. Investors who bought those assets with leverage face margin calls. They are asked to put up more collateral or close positions. Forced selling pushes prices down further, falling prices trigger more selling, the classic feedback loop. At the same time, in the background, those who have relied on Japanese credit for years begin to worry. The yen strengthens, yields on Japanese bonds rise, the central bank cautiously tightens policy. The carry trade, which used to look like a low-risk money machine, suddenly turns into a source of pain. To repay their yen loans, investors have to sell assets across the world. They are no longer looking for the perfect timing, they just need to plug the hole. More selling, more downward pressure on prices. At this point, the so-called shadow banking system enters the turbulent zone. Funds, private lenders, structures that are heavily exposed to risky bonds and complex products. When everything was going up, they were return geniuses. When markets fall and liquidity disappears, it becomes increasingly difficult for them to sell these assets at reasonable prices. Repaying obligations gets harder, then trust erodes, then funding dries up. Formally, large banks may still look solid, but they are connected to this system through loans, derivatives and funding lines. And the shock in the shadow sector quickly spills over into traditional banking. This is how a single shock can slowly turn into a chain of events that affects everything, from Japanese government bonds and UK-based funds to stock prices in the US and Europe. Right now, analysts and regulators are discussing several possible future paths. There is a soft version where markets cool down gradually, asset prices drift lower, the bubble deflates slowly, regulators patch the most dangerous holes, and the Bank of Japan moves very cautiously. This is the long, somewhat boring correction scenario. No massive crash, but the euphoria fades. There is a stagnation scenario, where markets no longer deliver the spectacular growth they once did. Economies crawl forward with weak momentum, and real returns, after inflation, remain low. It's not exactly a catastrophe, but it's definitely not the story of endless upside that many have become used to. And there is the hard scenario, the one most often used in alarmist videos. Here, the initial shock is strong. Markets drop sharply, Japanese funding contracts, and the shadow banking sector sits at the epicenter of the crisis. This path is not written in reports as inevitable, but its components are being analyzed in increasing detail. What matters is this: even the most conservative institutions now openly acknowledge that the system has become far more sensitive to unexpected shocks than it was just a few years ago. Now, the important part. Everything we're discussing in this video is not an investment recommendation. It's not advice to get out of the market immediately, buy only gold, or bet everything on a crash. The goal of this breakdown is to show what the bigger picture looks like and which weak points are visible to those who observe this system from the inside. For an ordinary person, there are a few very simple takeaways. First, building your financial life on the idea that markets always go up if you just wait is risky. History shows that long periods of growth are often followed by painful corrections. And the stronger the preceding boom, the more noticeable the pullback tends to be. Second, in such an environment, any story involving high leverage, complex financial products, and promises of almost guaranteed returns becomes especially dangerous. When the system is fragile, the first major hits land on those who are overloaded with risk. Third, it makes sense to think not only about how much your assets earn, but also about what happens to them if liquidity suddenly dries up. When the news starts to talk about panic, selling anything at a fair price becomes much harder than it looks on paper. All of this deserves a separate, detailed discussion: how to structure personal finances in a world where the global system has turned this nervous. If you zoom out from the daily charts, you can see that we're living through a very unusual moment. English regulators are politely but persistently warning about rising systemic risks. International organizations are talking about overvalued assets and market fragility. The Japanese era of ultra-cheap money is slowly coming to an end, and with it, the familiar architecture of global capital flows is changing. On the surface, this still sounds like a set of technical statements, but inside those reports, a familiar storyline is gradually forming. Global markets are standing on a much shakier foundation than the optimistic presentations usually show. And this is where your opinion becomes interesting. What do you think is most likely to trigger the next major market shock? Politics, debt, a tech bubble, Japanese credit, or something completely different? Let me know in the comments which part of this story you'd like to see explored in a separate video. A deep dive into Japanese credit and the carry trade, a closer look at the shadow banking system, or a practical episode on how all of this translates into the life of a specific person, their savings, loans, job, and long-term plans.